All right, let's get more on Janet Yellen's testimony with Craig James. He's a managing partner at Precision Advisors. Craig, good to have you back on the show.
Glad to be back.
Craig, Janet Yellen saying that they're going to take a cautious approach. Overall, what was your biggest takeaway from her testimony today?
Well, she certainly stayed true to form. It wasn't much in the way of a lot of narrative there, other than the fact that she said she would wait and validate. I think that remains to be the posture of the Fed. They want to see what comes out in the way of jobs reports over the next 2 months. Obviously, we have this large kidney stone called Brexit that everybody's worried about, that the market could eventually pass. That is certainly on the minds of the Fed. They would like to see what happens, and I can't give them any, I certainly understand that position.
Well, a very dovish tone was taken, which is very different to the tone that we had prior to the last Fed meeting, where the Fed was sounding very hawkish. In fact, a lot of people had a summer rate hike on the table. So what does this tell us about the U.S. economy that now the Fed seems to be pulling back so much?
Well, we have seen a little bit of deterioration with respect to job creation. The indices that the Fed is looking at have shown a deceleration with respect to job growth. So that's concerning on a level. I think the Fed is mostly concerned with having to reverse posture if, in fact, there is some calamity surrounding Brexit. Obviously, that's a clear and present danger. So they would like to see over the course of the next 3 or 4 trading sessions how the market digests that kind of stress, if there is to be stress, and they'll proceed.
Well, before we get to Brexit, you mentioned the word calamity. And the argument has been made that the Fed now has absolutely no weapons left in its arsenal, very few. If a black swan event were to occur, the Fed can't really do anything, and that it should raise rates just for the sake of having some room to maneuver. What do you say to that?
Yeah, I don't know if I agree with that. I think the Fed gets a hall pass here. There's certainly a lot of things on their radar. Brexit is not easy to handicap. It's anybody's guess as to how the market's going to react. Sterling weakness, it's down 20% over the course of the year. In the options markets, for instance, there's still a threat of continued weakness in the sterling. The out-of-the-money puts are trading at a 6-vol premium to the equidistant out-of-the-money calls, which is indicative of the fact that there's a lot of fear still. So for the Fed to sit on the sidelines until they get some degree of clarity, I don't think there's a question that that's
Well, we're going to get some clarity on Thursday. And what are your expectations? Do you think the UK will vote to stay in the EU?
I think they will. I think ultimately, and again, that's a wild guess on my part. It seems like it's going to get down to very much a Thursday morning decision, and it'll be very close. But if I had to handicap this, a gun to my head, I think they will stay in the EU.
And what do you expect the global market reaction to be Friday morning?
Well, if I'm right, I think that, and that if that were to occur, I think the market would probably relax a bit. There would be a risk-on event that you would expect people to start to feel more comfortable getting out into the equity markets, into credit markets. So, but of course, there's always the position that they exit. That's obviously a more interesting scenario.
So let's say Friday morning they have voted to leave the EU, the Brexit campaign wins. What do we expect to see?
Well, cats and dogs sleeping together, of course. I mean, it's going to be mass hysteria.
Well, is it going to be that catastrophic? We've been bracing for this. Markets have been pricing this in. This can't come as a surprise. People should have been hedging for this.
Listen, obviously I'm kidding. I do think in the short term there's going to be a crisis of confidence. And I think that's the most immediate concern for central banks, is just to quell the panic that goes on. These trade agreements will take years to figure out if Great Britain would leave the EU. So that will be a slow motion effect. But, if on Thursday there is a referendum vote such that Great Britain leaves the EU, I would imagine that you would see, a safe haven buying, a flight to quality. You would see a risk-off event of fairly significant magnitude.
Well, the Brexit is not the only risk on the Fed's radar. What are some of the issues that Janet Yellen specifically pointed out when considering raising rates in terms of the global economy?
Well, she's, again, looking at forward guidance still to some degree, and I think employment is still the key marker for them, and looking at the labor market, the conditions. I do want to present a scenario, however. I think the market is still very dovish, and if you look at the difference between FOMC dot plots and Fed funds expectations vis-a-vis futures, the market still really does believe that we're in a lower for longer scenario with respect to rates.
Well, that is also what she said as well. Now, the term recession came up. We never like to hear the word recession. And she said quote, the chances are quite low. Now, we watch Fed language very, very carefully. So the words quite low, not that encouraging, are they?
Well, I'd prefer to hear zero, but that's never the case. The fact of the matter is, if there is to be a recession and job destruction occurs and there's less business spending, it would be difficult for the American economy. Clearly, that's what a recession is. What's more interesting, however, is this concept: would the Fed ever pursue a negative interest rate policy vis-a-vis Japan and the EU? Our answer, on our side at least, is they would not, and for the following reasons. Number one, a negative interest rate policy would destroy the financial sector as we know it.
But she said it's a legal option. It's very unlikely that that's going to happen. Very quickly, though, what is your prediction on the next Fed rate hike? Are we going to see one this year?
I think we will. I think that you could see in front of the election at least one hike. If not in September, you could have one here in July. So I think the opportunity for the Fed to respond proactively, I do believe they'd like to get ahead of inflation. You've seen an uptick in PCI inflation. If Brexit quickly dissipates, like we've seen in previous Armageddon scenarios,
right.
If it quickly dissipates and all of a sudden you're seeing job creation growth tick up, coupled with a little bit more inflation, you could see the Fed get highly motivated here, and I think the market's not anticipating that at all.